The Federal Reserve. So there's a couple things you have to keep in your mind as we talk about the Federal Reserve, because it's easy to call it our bank, meaning the United States of America's bank, but it kind of is, but it kind of isn't. So when you think about banks in America today, you probably can just name banks that you see all around your town. Those are private banks, but they are regulated by the government. And so the Federal Reserve and the United States government, like Department of Treasury, they do have some influence on those banks. But those banks are companies, they're trying to make money. But the Federal Reserve System is really not going to make money. It's not out for profit, right? It is our government, an independent part of our government, trying to kind of regulate our economy and watch over our money system. But it's separate a little bit, I should say, from the actual government. So once you're appointed to be part of the Federal Reserve by the president, you're independent and you do what you think is best. So while you are part of our government, you're an independent part of our government. So there'll be this video and a few others in this module that'll help you understand what the Federal Reserve is. But if it helps to think of it as our national bank, that's fine too. But if you're in charge of this country, whether you're the president or member of Congress, we've learned, right, you never, ever, ever just say the answer to our economic problems is just print more money. That's never the answer. That's always a problem. Now, of course, old money wears out. New money has to be printed all the time, but there's a delicate dance that's done between taking old money out of circulation, putting new money in. But that's not what this video is really about. It's not about the printing of the money. It's about how easy it is to borrow that money. If money is easy to borrow, then that is basically like putting our foot on the gas pedal of our car. It makes the economy go. If money is harder to borrow, more expensive to borrow from banks, then that's like tapping the brakes a little bit on the economy. And that's all done by the Federal Reserve. So it is a bank, but it's also kind of run by our government. And the idea is they regulate how easy it is to borrow money. The Federal Reserve sets interest rates, meaning how much it costs to borrow money. And that is a huge deal when it comes to setting the growth of the economy or reeling in inflation or hitting the gas a little bit and wanting the economy to go a little bit faster. Now, you may have never really thought about the Federal Reserve, but I know you've seen it, right? So if you take a closer look at maybe a $100 bill, you see that on our money, on the actual notes, it'll say Federal Reserve Note. And it says United States Federal Reserve System. It also tells you who the Treasurer of the United States is, which is a nice job, but it's not as powerful as the Secretary of the Treasury. Both of them are important, but neither one of them are part of the Federal Reserve System. So there's two separate systems here. We have our federal government, which would be the Treasurer and the Treasury Secretary. But we also, more importantly, this is a Federal Reserve note, meaning it's a note from our national bank system, which is run by the Federal Reserve. So the Federal Reserve, right, it's an independent government agency that you get put on that by the president, approved by members of Congress. And once you're there, there are basically 12 regional banks. So there's actually, multiple spots on this Federal Reserve System. There's 12 regional banks all around the country. These regional banks kind of watch over the economy of that area. They kind of see if it's booming or if it's slowing down. They will meet every once in a while. All of them will decide, well, what will the interest rate for borrowing money be? If the country is going too fast and there's too much inflation, then they'll say, okay, we need to raise the rates. That'll slow things down. Or if the economy is already going too slow, they're like, okay, let's lower the rate, meaning make it cheaper to borrow money so that people will go and buy things like new cars or use their credit card or buy a new home. That will get the economy going. Of course, if you are on the Fed, you are responsible to our government. They might have you come in and testify. And if after your term is up, a new president or the president will put someone new in your spot. The idea is it's independent, but it's still part of the federal government. But it's not like the president can pick up the phone and boss the members of the Federal Reserve around. Once they're there, they're independent, they do what they want. It's kind of like the Supreme Court, but for money. So they handle all the money, they're bankers, and they decide when it's time to hit the gas or hit the brakes. So it's more than just one building, though. There are 12 buildings with Federal Reserve, we'll call them governors, around the country. So the Federal Reserve, they manage inflation, they supervise all the banking systems. So if you think about a bank in your neighborhood, maybe it's Chase, Fifth Third, they are private companies that operate under the watchful eye of the Federal Reserve. So the biggest thing that you're ever going to do probably in your life financially is buy a house, right? So that's the biggest purchase most people make. Most people probably just can't walk in and pay for a house with cash, so most people have to get a loan. We call a loan for a house a mortgage. So generally, you go with two options. You can get a 15-year mortgage, which means you pay a higher rate for 15 years, and after 15 years, the house is yours. Or I say most people go with a 30-year conventional mortgage, which is maybe a lower payment, takes a lot of your life to pay it off, but after 30 years, it is yours. But again, most people don't have this kind of cash laying around. You know, a house might cost $400,000. So someone who's 25 years old doesn't have $400,000. Most people don't. So you have to go to a bank, show to the bank that you have a job, you might have a little bit of money, and the bank will give you a loan, whether you're going to Fifth Third or Chase or Bank of America. These are all private banks, but here's where the Federal Reserve comes in. The Federal Reserve sets the interest rate, not only for home purchases, but for all kinds of things that you would buy using a loan. So nothing small. Most people don't get a loan for television, but the Federal Reserve would set the interest rate for big purchases like automobiles, credit cards if you have a big balance on your credit card, but mostly homes, because that really is one that will really get the economy going or slow it down. So the Federal Reserve sets the rate, and all of the private companies that you can think of, they have to abide by that rate that the government, the Federal Reserve, sets. So on this chart, you can see through the years from 1972 till 2012, you can see in that 40-year period what the interest rates were. I mean, we're talking up to 18.5% in the early 80s, and now, you know, way down in the 4s and 3s in the 2000 teens. So the Federal Reserve is trying to sometimes hit the brakes, hit the gas to get the economy going. They can't do a lot because it is a free market, but the government, through taxes and regulations and government spending and the action of the Federal Reserve, can try to control the economy somewhat. Maybe it's helpful to think of it as like a loose or tight. Okay, sometimes the Federal Reserve is like, okay, let's be loose with the economy and let it go. We'll lower the rates and let people borrow and the spending go, and let's see how fast this thing can go. But then sometimes, like, oh, it's going too fast, inflation's growing too much, we better hit the brakes, tighten things up a little bit. So raise the rates, make it more difficult, more expensive to borrow money. Therefore, people pull back a little bit on their spending. They don't buy as much. It kind of just slows the rate of inflation down and the growth of the economy. So think of it as a loose tight. It's very, very dependent on what's happening in the economy at that moment. Now, this isn't a guarantee. These bankers who are part of the Federal Reserve, these governors who are put there by the president, approved by the Senate, they do the best they can based on what they know about economics and about the economy. But they generally understand that if you want the economy to go faster, you loosen up a little bit and you make money cheaper to borrow. But if you want it to slow down, you tighten up the money a little bit, make it more expensive to borrow. So the Federal Reserve does its best to try to control interest rates, to control the way the economy moves along, mostly worried about inflation, making sure that people aren't suffering. You know, if inflation's too high, then, you know, you can't afford some things. So they're always watching how much things cost, how many people are employed, who's working, who's borrowing, all of that. But in the end, The Federal Reserve, these governors across the country at the 12 different Federal Reserve banks, they're charged with setting the interest rates on big purchases, which is one main tool in guiding the economy, guiding it as best we can. It's not an easy task, guiding the American economy.